The primary purpose of this podcast is to educate and inform. The views, information, or opinions expressed by hosts or guests are their own. Neither the show nor any of its content should be construed as investment advice or as a recommendation to buy or sell any particular security. Security-specific information shared on this podcast should not be relied upon as a basis for your own investment decisions. Be sure to do your own research. The podcast hosts and participants may have a position in the securities mentioned personally through sub-accounts and/or through separate funds and may change their holdings at any time.
Welcome, everybody, to a new episode of This Week in Intelligent Investing. Great to have you with us again. Great to say hello to my co-host, Elliot Turner, and welcome back, special guest, Bill Chen of Rhizome Partners. It's been a little while that Bill has joined us and talked all things real estate. There's a lot to talk about. Bill, I know you're seeing a lot of interesting opportunities. We'll get into that, some of the trends you're seeing. So over to Elliot, maybe for a couple of words as well.
Yeah, thank you, John, and welcome back, Bill. I think it's really timely because if you reflect on our conversations last year and you think about some of the key points, this big spread between public and private markets, some of the stabilizing trends we talked a lot about multifamily back then, but also across strip malls and basically all facets of the real estate universe. They're largely consistent with where things were last year, despite interest rates having come down considerably, especially of late. So not much has changed, but a lot has changed. And I think there's been a couple interesting cases of assets taken private from public markets, which shows a lot about this value disconnect. But meanwhile, many of these public stocks are still kind of languishing. They'd had a brief rally and they're mostly back to where they were when we talked about them last year. So I think it's great to have Bill back on, get to revisit some of these names, but also get to talk about what's changed and what's not changed in the last year. So welcome back, Bill. How you doing?
Great. Well, it's always great when I get to chat with you guys in this format. I really enjoy this, and to what you were saying, I went over the previous podcast and thought about some of the topics. Are these public NAVs correct that the companies provide? Why is there such a big disconnect? And what's happened in the last 18 months since probably the last podcast we did together is that there's been a massive amount of kind of smaller to mid-sized REITs that got taken private. And I'll just go through a list of a few that like we've been involved with, right? So a big one is that Blackstone agreed to buy a pure play Hawaiian grocery anchor warehouse REIT called Alexander and Baldwin private in a $2.3 billion deal. About 13 months ago, Blackstone also bought a company called Retail Opportunity Investment Corp. So that's just Blackstone, back to back, right on holiday time, buying two, last year's deal was $4 billion and this year's deal 2.3. So just within the grocery anchor shopping center, which we kind of mentioned on previous podcasts that we really like that space, there's two deals done for over $6 billion in enterprise value. And then the multifamily side has been very, very active. Early this year, there's a company called Dream Residential that got taken out. There's, Elm Communities, which is previously called Washington REIT, which is this REIT down that focuses in the DC area that's been public for, I think, like 40 years. Not the greatest long-term track record. They they were kind of subscale. They never grew to the right size. And there's a trend, there's like this trend where REITs that are below $5 billion in general, that trade at very, very large discounts to private market value, have been sold and taken out. There's also a lot of kind of partial asset sales, non-core asset sales, where companies are selling assets or orderly winding down. Aimco is one of those companies. That's, Blackstone bought the company called Air Communities, which is kind of the parent company. They spun off a kind of like a, hodgepodge asset called Aimco. And so Blackstone bought Air Community in a $10 billion deal. And then the Aimco itself, trying to kind of become a standalone company that has a lot of development projects, that they've just decided to, wind down completely. Site Center, which is a retail REIT, they spun off a REIT called Curbline. Site Center just announced that they're going to finalize their wind down. So there's a lot, and to Elliot's question on the first podcast we did, are these NAVs correct? Like, is there a way to monetize it or to close that gap? It doesn't seem like, as of now, it doesn't seem like a lot of the large cap blue chip, the discounts are still there, but it's harder to write a 10, 15, $20 billion check to do a deal. But anything below $5 billion, there's been a lot of activity. And I just did the math. This is a little bit crazy to say out loud, but like, we've had something like over 40% of our portfolio get taken out, probably 35% of it just by Blackstone alone in the last 13, 14 months. And then Dream Residential is the other one. There's a hotel REIT called Playa Hotel, which has been public for 10 years, just kind of never worked as a public traded company. They decided to sell, and that was bought by Hyatt. So if you're enterprising investor, in this space, even though like the large cap blue chips, the market's like not giving them any credit, truly the Rodney Dangerfield of public traded asset classes, if you know what you're doing, you can kind of like there's a lot of liquidation plays, and there's a lot of these takeouts, take privates. So I'll stop there. I'll take a breather, I'll let you guys see if you guys have got any questions.
So yeah, I think it's really interesting you're reflecting on my skepticism about the NAVs as stated by these publicly listed REITs. I'm curious, what sort of premiums is Blackstone paying? What sort of cap rates are they taking them out? You've kind of said it, but like, are they able to harvest some of this value arbitrage from public to private themselves, or are they paying up to full value?
So the answer is, in my personal opinion, I think Blackstone got a really good price in both deals that they did in the grocery anchor shopping center. In the case of ROIC, Retail Opportunity Investment Corp, that's a pure play West Coast grocery anchor shopping center, very high barrier to entry. They bought it probably even at the premium that they pay. So let me go through the premium. I think we started buying at $12. News came out and said that Blackstone was interested in them. It was kind of 15 or so. We added more to it, and then eventually got taken out at 17.50. So probably about 40% premium on a unaffected, share price. And then on the premium on the deal rumor is probably about, call it high teens premium. And then on the Alexander Baldwin, that was a 40% premium on the unaffected. Now, to be fair, Alexander Baldwin were, for whatever unknown reason, kept selling off in recent months. And, we kept buying Alexander. And then so it was 40% premium, but like after the company has sold off, a good chunk. So it seems like 45% is like kind of the premium to unaffected price. But yeah, I mean, I think Blackstone's going to do really well on both of those acquisitions because they're buying really high quality assets.
And it's kind of interesting that the money is there on the private side to buy these public assets, and the sellers seem pretty willing. Why do you think this activity has not translated into a re-rating of some of the other small publicly listed REITs, where you now have some at least validation that the NAVs are real, that these companies do have value, that private buyers are willing to step in? What do you think has held the market back from repricing?
I think that it kind of still requires a lot of specialist knowledge, right? It still requires I mean, as as like, I think that if you think about how many investors that are out there, let me paint the picture of like the REIT investment world, right? The guys who manage a lot of capital, the REIT mafia types, they probably have too much money to allocate to be able to nimbly move into call it like the sub $3 billion space, right? The sub 5 billion. Like once you get below $2 billion market cap, a lot of like the Nuvings and Cohen Steers of the world, like they can't really allocate a lot of capital. And a lot of the smaller ones trade at large discounts to NAV because the bigger dedicated REIT mafia types don't own them because of the liquidity issue, right? So the discount exists because the bigger guys can't own them because of the liquidity issue. And then if you think about like who really knows how to pick REITs in that sub $2 billion space, there's not a ton of people who have that kind of expertise. I kind of know, like a lot of people who are actively doing this right now. There's probably maybe like a handful of them that I talk to regularly, and so I think that it's a situation of there's not a ton of capital being deployed in this area of trying to figure out which REIT has a very high chance of being bought out, right? And often at a pretty good premium, and also just like the amount of capital that they manage. So it's kind of this like perfect environment for someone who's very enterprising, who's got, a ton of experience. And also, I would say that like another bottleneck is a lot of times figuring out who is likely to sell kind of requires that you met with management team at least like 3, 4 times, and where, like, in the case of ROIC, Retail Office Investment Corp. And Alexander Baldwin, we know management for at least, 3, 4 years, right? We talk with them, we find them to be rational. We felt like they watch out for shareholder interests, and so we like generally like do we know they were gonna sell within, 6 months of us buying shares in them? No, we didn't know that, but, like, we generally felt comfortable with them managing, running companies for us, even if there is no sale of the assets. And then there's just, like, if you kind of create this Venn diagram of, like, know which management team is shareholder friendly, who will, like, kind of maximize shareholder value, which company is frustrated by being a public company where that they're just not getting the valuation that they deserve, and and just like very long period of like stock share price like underperformance, and which company trades at very large gap to like private market value, right? Like what we're generally finding is we're not getting every last dollar on that math, right? Because I'm sure every buyer would love to make 15% IRRs on their purchase. And what we're generally finding is that, unlike in a ZIRP period, with every asset sale, like, public shareholders often will be able to maybe like not extract every last dollar in a take private, but like, it's probably hard for the buyer of decent sized public REIT to be able to eat like very easily underwrite to 15% IRR. Maybe like they could get a 10% IRR back then. In today's world, like the buyers with, ample, with the right amount of leverage, they could very easily, get, 15% IRR. And I've had conversations myself with, a former REIT CEO about potentially, bidding on some public companies ourselves, right? And we run some of that math, and so you don't get to maximize the entire NAV, right? Like you don't get to monetize the entire NAV. You usually get some discount to it, but like I think the math is if you're buying a REIT that's very deeply discounted at 40, 45%, 50%, discount to NAV, and then it gets taken private at a 15% discount to NAV. I mean, both the public guys win, the private guys win, and there's price discovery. So that's kind of been what's happening.
I mean, one of the things I keep wondering, though, given this backdrop and given how willing private buyers are to step in, why haven't more management teams at these REITs said, listen, we're putting up a portion of our portfolio for sale. We're confident we could sell it for NAV, and we're going to use the proceeds to buy back a meaningful portion of our shares, so long as the discount to NAV persists. Like,
Well,
why not take action? It seems
yeah.
logical.
No, I mean, and it's happening. It's happening. So like Camden which is, a Sunbelt multifamily REIT that we talked about quite a bit on the previous podcast. They've sold some of their older non-core, generally, the assets are 25 years old, in a location that they don't consider to be core, or, they just have a tough time managing them. They sold older assets to buy back shares. And so Camden, bought back $50 million of shares in the third quarter. Avon Bay, bought back $150 million of shares in the third quarter, if I remember correctly. So it is getting to a point with the valuation. I think when we were talking 18 months ago, 2 years ago, I think a lot of them thought, oh, the Camdens and Mid-Americans of the world have the best, the most pristine balance sheet. So they were perhaps, waiting for distressed opportunities where maybe they could buy a brand new building at a 6.5% cap rate, even though they trade at 6.5% cap rate. But they're buying a brand new building where maintenance capex is very low, and they will likely be able to grow rent over time. Generally, the existing portfolio is a little bit older, but generally pretty good. But they're not 0 years old, right? They're not brand new. So I think they were holding out for a potential opportunity where the public REITs could flex the balance sheet, could flex their access to liquidity, and they've been issued to issue debt at very, very low rates, 5 to 7 year fix at below 5% consistently during this time period. So they have, the public REITs have access to capital, but what hasn't materialized is that these extremely distressed multifamily deals. I think there's a couple multifamily deals that they bought in the 5.5 to maybe 6% range, where maybe they come in and do a little bit better job leasing it up. But for the most part, and I'll give you guys a quiz, where do you think multifamily cap rates have settled at? Because when we were doing the podcast, heavily 18 months ago, there was still a lot of question. The Fed had just raised rates in 22. There weren't as many multifamily transactions. And we were still in this like kind of discovery period where what is the right cap rate for multifamily? What do you guys think multifamily cap rates have like settled at?
I read your letter, so I'd be cheating if I tried to answer this and showed my knowledge.
I'm gonna tend higher probably because I
Okay.
view inflation as a real issue. So I'm just gonna
Mhm.
say high single digits.
Nope. The multifamily cap rate, and we have, we have some, great data that we track, ourselves. What we have seen is multifamily cap rate, despite, higher interest rate, despite all the drama about Sunbelt oversupply, et cetera, have consistently come in that low 5% cap rate. With, if you look at the, like we track probably 15 transactions ranging from 100 million on the low end to, on the high end, the lowest being 85 million, the largest being 10 billion, which is Blackstone's deal. As long as the assets are under 20 years old, and and all over the US, cap rates has consistently been in that, 4.9 to kind of 5.4 range. There were three transactions that sold that trade above 6% cap rate, with the highest being 6.8, which is Dream Residential. They all share similar issues, right? They're generally like not in like the best geography, called like Oklahoma, Cincinnati, right? They're generally a lot older. The youngest in that basket is 33 years old, and the oldest is actually over 50 years old, outside of like in Rhode Island, about an hour outside of Boston. So like there's this bifurcation in multifamily cap rates where if an asset is even if they're in a high supply market like, you know, Dallas or Phoenix or Houston, in those kind of high growth markets, even with the high supply issues, they consistently trade between like, 4.75% cap rate to kind of 5.4 cap rate based on, all the transactions that we tracked. And the other thing is that, on the multifamily side in particular, what we're seeing is assets that are below $150 million are able to transact. Assets over $150 million are a little bit harder because I think from a real estate GP perspective, it's harder to kind of tell a story. Oh, I'm going to buy a 95% occupied Class A apartment building in a good location, but there's not much value add that it can add to it, right? It's essentially a core holding. You just got to run it and keep occupancy at 95%. So, so those are actually harder to sell. What's easier to sell is below 150 million. Maybe the occupancy is at 91%. You could go in there and increase occupancy to 95. Maybe you could renovate the kitchen. Maybe you could spruce up the common area, et cetera. And the GPs could say, well, look, we could buy this at 5, but when we're done, with our magic sauce, this is actually a 5.6 or 5.7. And on the financing for multifamily, we're starting to see financing costs go below 5% for single multifamily assets with like 5-year terms, interest only. So like the private market is starting to get to a point where like leverage, leverage neutral, leverage positive, like being leverage negative from day one is a big issue buying these assets, right? And the financing costs, we're starting to see that come below 5% on 5-year loans. So the private market is way more active. Like if you believe that the private market is the right, price, is the right price, I'm looking at a spreadsheet that has got 14 transactions, all done after 2022 that shows cap rates, in that 4.9 to 5.4% for everything under 20 years of age.
Could we come back to that Camden deal? Because I find that interesting in light of all these dynamics. What sort of valuation were they able to get on their older non-core assets? Like, are they getting full NAV, fair value?
And
How do you think
so,
about
so,
that?
so for a company like Camden, it gets a little bit harder when they sell like a one-off asset because they own so many of it, and it gets harder. We could kind of like I tried backing into like what the implied cap rates would be using, what kind of rent they could get in those markets. They're generally like, even on their worst assets for Camden, the cap rates are probably mid to high 5 cap rate on like their older assets that are like non-core, that they're having the most trouble with. They're still getting, call it like mid 5 to high 5s on those.
Wow, interesting. So probably it's still less than the implied cap rate in their stock for the full company. And these are their
Absolutely.
non-core, they're older, they're less good assets.
Yeah. Yeah. And like if you pay attention to like what they're selling, I was looking at one of the assets they sold, and like the comments is, this isn't a dangerous area. Like there's been like X number of shootings. Like, those are the assets that they're getting rid of. And I mean, the core portfolio, what's remaining, if you drive around in the South, we were down, we were on a business trip recently and we saw some of the Camden buildings. I mean, a lot of them are very well maintained, very well kept, good location. When we were down in South Florida doing due diligence last year, some of their assets they have in South Florida are, right on the water. I mean, they own some really good assets, particularly Camden. The average rent per apartment is $2,000, which for the Sun Belt tends to be on the higher end. And so, yeah, the remaining, what they're keeping are pretty good assets.
When you think about like the multifamily dynamics, we're talking a lot about valuations. If you
Mhm.
go back to last year, one of the themes that we discussed was there was this prolonged period of aggressive supply build.
Yes. Yep.
So maybe talk about the supply demand dynamics. It seems like everyone's pulled back from building, but is there still too much supply on the market? How are these places filling up? What's happening on that front?
Sure. So if you, we'll talk about supply, and then we'll talk about like, so supply. We were saying, when we really became vocal about this, and this was right around 2 years ago. When I first, talked to Andrew Walker and Bill Brewster about this on their podcast, I was kind of pounding the table and saying, and the development economics doesn't work. Under the new interest rate and the new exit cap rate of 5%, developers could only, based on everything that we know about construction costs, cost of construction loan financing, they could only develop to 6 to 7% IOR, and that's just not attractive enough for LPs, right? And we kind of predicted like 2 years ago that like all this new development it has stopped, and they'll trend a lot lower. So I'm looking at a chart, and it like all that supply, e essentially, like, this is probably the last year of, elevated supply. I mean, it's already peaked. It peaked in '24. The apartment supply delivery peaked in '24. '25 is a step down from '24, and '26 is expected to be a lot less. And '27, '28 looks like it will be below the 20-year, average. So we're gonna go from a period of, like, the largest supply being delivered to now we're actually going to go into a period. If you believe in capital cycle theory, we're going to go into a period in probably in call it like 26 to likely till 29, where we're probably going to be a good amount below the 20-year average. Now, keep in mind the population in the particularly in the Sun Belt has grown a lot in the last 20 years, right? So we're going to be below, on an absolute number perspective, below the 20-year norm of new supply being delivered. And you have you have a bigger denominator. So the percentage being delivered in the Sun Belt is going to be, significantly lower than kind of like call this like pre-COVID, boom.
So do you think there's a chance we end up like underbuilt for where things need to be if you fast forward to this, you know, early 2030s?
No, absolutely. Now we don't like model like I think we Bob Robotti is someone that I respect a lot, and his capital cycle theory, he's executed very well on that. I'm seeing this kind of played out in real time in not just in multifamily, in warehouses, in self-storage. I'm literally looking, Elliot, I'm looking at charts right now. And and then maybe we can post some of those charts later. But in every single of these categories, like you're absolutely seeing a huge spike in deliveries in call it like from 21 till now, and most of them are, have been absorbed by the market. Now, one question may be, well, there's this unprecedented, new supply being delivered in the Sun Belt. What's happened to occupancy and rent? Let's talk about that a little bit. Both Canada and Mid-American have done an excellent job of keeping occupancy at around 95.5%, in the past like year or two. And in essence, like, the bigger they have a more diversified portfolio, they're able to essentially price their apartments, such that they maintain 95% occupancy. So despite all this, delivery, right? All the biggest supply, and which everyone was terrified of, occupancy has stayed at 95%. So from an absorption perspective, there's been an incredible absorption of apartments. But
Uh,
what has suffered a little bit, and by a little bit, I mean literally their net operating income, same-store net operating income, for Mid-American has been like -2% in this entire time frame.
is that because rents are not really growing amidst this wall of supply and their costs as operators are going up?
Yes, yes, that's exactly what's happened. And in certain markets like Austin and Nashville, rents even fallen in that time period. So there's, but across the entire Sun Belt, they're starting to see. So yes, so Elliot, yes, you have very, very muted rent growth. And even in some markets, there's some rent that even fell from its peak. And everyone knows that property taxes generally have kind of stopped its rise. Insurance was a big issue, and then you just kind of have like traditional, rise in labor costs and operating costs and utilities. But so yeah, I mean, but a lot of the expense growth have also moderated.
So what puts a floor in falling rents in these markets where it has turned lower?
I think a lot of that floor is just like the supply, in my personal opinion, the supply being, not having I'll paint a realistic situation, right? You're in a market, you have a 95% occupied apartment, your tenants are happy, but there's a new supply, there's a new building, down the road that just opened up, and they're trying to go from like 0 to 90% stabilized so that they could, refinance or sell that property. And they get to a point where they're 70, 80% occupied, but they can't quite get to 90. And then they get to a point where they're trying to put new tenants in the building, but some of that older tenant, that some of the existing tenant, their 1 year lease is up, right? So now you're trying to like, fill the new units, but you got to deal with like your existing tenants like turning over as well. And that kind of dynamic, the new developments have, frankly, made some of those players a little bit irrational in the market, right? Make it difficult for the existing guys, for everyone to be able to raise rent. Obviously, that is a net positive for society because there's lower rent. But as a apartment owner, like you've been stuck in this. But I think we're at the very very tail end of that dynamic right now, and I think we're about to go into a multi-year period where, barring some sort of extreme macro event, I think we're going into a few years where we're probably going to have, short rent, unless, yeah, again, like unless there's some sort of large macro event. And then from the public, apartment REIT perspective, that's kind of the new boogeyman, right? The new boogeyman today is that's one of the new fear is, there has been some, growth macro seem a little bit weaker today. And, I think like immigration policies are net negative for apartments. And, some of this like tail end of the supply hitting, like, but like I think from a supply perspective, we're very much near the end of that supply being absorbed, and then we're going to go into a very low supply delivery environment in the next call it like 3 4 years. We don't put this in our model, but the public REITs, the public apartment REITs, have commented that the new supply environment reminds them a lot of the post GFC environment where they were able to grow NOI by 4 or 5% per year. Now we don't use that as our assumption, right? But like their comment is there were very little supply built after the GFC. They're kind of in a similar environment today, and they have like a 4 or 5 year period where they could really grow their NOIs by 4 or 5%. And I think that's what makes some of the large apartment REITs like so interesting today is that they're currently trading in the mid 6% cap rate. We think that there's a lot of evidence that these are 5% cap rate. And then if we go into a few years where everyone wants to own them again, and that could be, like next year, right? Everybody wants to own these apartment rates because now we're going from, NOI decreases to actually NOI accelerating. It was like hard to kind of say that out loud in the past 2 years, but like I think we're like nearing that inflection point.
Do you think there's a degree to which, so there's this pause in development that's been underway for a couple years now. When development comes back online, the last decade really saw the multifamily explode in the Sun Belt.
Yeah.
But like, do you think when it comes back, when building comes back, that there's a different market where there's a huge supply demand imbalance and the building is focused in different geos, or is it still like Sun Belt is the net grower?
I think probably, I still think that more of the supply will probably happen in the Sun Belt, just simply because it's easier to build, easier to do business. I think that, you know, like just compared to a market like New York City, Miami, or Southern California, from everything from a zoning perspective, anything from like a cost of raw land, developable land perspective, I do think most of it is gonna be in the Sun Belt, but the Sun Belt is the region where they continue to have like more population growth and more net migration.
We didn't really get to the rates thing. So like, what effect do you think rates having all this? Do you think rates lead to more development? Do a lower rate environment support building out more new multifamily rates and their effect on valuation? Is that kind of constrained by the 10-year not really moving as rates come down? Maybe talk through the dynamics on the rate front.
Yeah, I mean, so on the rate front, what's really interesting is construction loans are generally tied to SOFR. So lower, the lower the SOFR goes, the easier it is to build new supply. Now, a lot of times, like there's a lot of paper out there saying that, multifamily cap rate is tied to the 10-year yield. But if you look at a lot of the recent financing, these like 5-year interest only loans, a lot of that cost is tied to the front end of the curve. So if we do get lower rates, yes, we will have more construction activity, new development activity. But again, that supply probably will take, I mean, depending on who you talk to, there's someone out there saying it will take 18 months to respond with supply. And then, there are people saying it may take as long as 4 years to deliver that supply. But I would say that, it would probably take at least like 3 years, it would probably take 3 years on average to respond with supply. But like, I think that once rates get cut, generally, you kind of, I just remember what happened in the GFC when we went into like looser monetary policy. It become, these assets generally with like higher yield and investors can't hide out in the 2-year earning 5% anymore. I think you're gonna have some, investors that actually, say, hey, a 4.5% in a multifamily that could beat inflation in the long run, that's only paying out, less than 80% of their FFO, or only paying out 70% of the FFO. That's actually very attractive by comparison. Versus, I only get 3.5 year in the treasury. And I think at some point people realize that it's great to own the 2-year, paying 5%, but I think that there's a convexity issue, right? Because if the Fed continues to cut rates, which like no one knows, if they're going to, but if they do, by staying on the front end of the curve, you run the risk that when your treasury matures, your 5% in 2-year is now 3.5%. You really do have reinvestment risk versus if you actually take on the duration, you kind of lock into that call 4.5, 5% yield initially. And then the odds that that could kind of grow over time and beat inflation, I think will make these REITs very, very attractive vehicles.
And maybe talk through the dynamics on the debt side, because I think if I recall, there was a lot of maturity looming in the second half of the 2020s from when we'd had ZERP. That's the extent to which the operators termed out their debt. How do you think that might influence things? Might that get some companies to consider selling who otherwise might not? Do you think these rates will kind of help them refinance, or is the 10-year the constraint there?
Are you talking about the private side, or are you talking about the public REITs?
Both.
Okay. So this is like a little bit of a puzzle. I mean, the easiest to know is that the big blue chip public REITs generally have no problem rolling their debt, right? They continue to issue debt at below 5%, 5 to 7 year fix. On the private side, what we've been seeing is, there's all these kind of alarmist headlines that there's coming war maturity, there's going to be so much distress. We I think that if you bought a property and you clearly overpaid, you use floating rate debt, which there were a lot of, right, in the Texas market, in the Arizona market, where GPs will buy at a 3.5% cap rate using floating rate debt tied to SOFR. And when they came due, their interest rate caps, expire, and all of a sudden, their kind of 2% effective interest rate became 5, and you bought an asset at a 3.5%. You clearly just couldn't service that debt, right? I think those are being flushed out by the market. But, in terms of like the private GPs who actually bought assets at a 5% cap rate, where there's been a decent amount of rent growth in a lot, since 2021. We're not seeing a lot of distress on that end. But it seems like the private market, the Fannie Mae's and Freddie Macs of the world are still, willing to roll those debt, extend those debt. Now, where I think like where we're hearing more is a lot of private GPs have to reduce the distribution or cut them. I mean, they're not handing the keys back to the bank, but they may have to cut that dividend or pause that dividend to kind of build up reserves, right? Which is a complete opposite of the big public apartment REITs like Camden, Mid America. And I mean, Camden over the course of 2 years increased their dividend by 5%, and Mid America increased the dividend by 8%, right? Which is complete opposite of what we're hearing on the private side. I mean, the debt capital markets for multifamily is still very, very healthy, unless
Y-
unless you very, very clearly overpaid and use floating rate debt from like 4 years ago.
Yeah, that's interesting on Camden, on Mid America in particular too, because you talked about how their NOI is down since we last spoke, but the dividend's still going up. Is that
Yeah,
just by having less developmental obligations, so cash flow is a little more available?
well, I think it's just like just how conservatively managed these REITs are run. And, if I remember correctly, Mid America would probably only pay now something like 60% of their FFO. So 67, like they have a lot of wiggle room to continue to grow dividends because a healthy ratio is about 80% of FFO. So even though Mid America had 2%, call it like 2% NOI decline over 2 years, cumulatively, right? There was still a lot of room for them to be able to grow their dividend just so because the payout ratios were so healthy. And same thing with Camden. I mean, Camden could probably pay a lot more in distributions. And they're just and that's like one of the big, I think misconceptions about a lot of these apartment REITs, right? A lot of time people will say, I remember, especially when the 10-year was around 5%, they're like, well, why would I bother to own these? And a lot of it is because the payout ratio is 70%. They'll be able to grow that. There's a lot of wiggle room. It won't be cut. You have inflation protection on one instrument, and you don't have inflation protection on the other, right? And that's a topic that we talked a lot about. So I think that you can't just look at the headline yield, right? You really have to look at the all in, like the all in kind of yield to equity owners for both Canada and Mid America is probably in that 7 to 8%. Like I don't have the exact number. Like I know the cap rates very, very well, but like the actual equity yield to owners is is over 7%. So sometimes a dividend could be misleading.
I maybe should have asked this one earlier, but like you talked about inflation there, and one of the questions I get asked about real estate is this general notion that for years people have talked about real estate as the ultimate inflation hedge.
Yeah.
Inflation, own hard assets, right? As the name of your fund suggests.
Yeah.
When you think about what's happened these last few years, we've had a lot of inflation, and yet there hasn't really been a worse period for publicly traded real estate
Yeah.
in, the last couple decades outside of the great financial crisis. So why do you think these assets have not been the inflation hedge everyone had assumed them to be? And do you think something changes, like if inflation is more persistent going forward, that these assets are likely to perform better? Curious your thoughts on that.
Sure. And our mutual friend Shy that's a great question, Elliot, by the way. And I have some thoughts on there. Our mutual friend Shy has shared a report by I believe it was a research team at UPenn that showed the REIT performances in this when we had that heavy bout of inflation, right? I believe like this is like going back to the 70s.
Yeah,
And
Soros' alchemy of REITs was in that
yeah,
decade. What
yeah,
started the alchemy of finance idea?
yeah. And if you look at the performance of REITs they were actually horrible for 2, 3 years. When we had that heavy bout of inflation, right? They were actually horrible. And then where the REITs really started to outperform was after that initial drawdown for the coming decade, they just like beat the pants off the equity index. And I think that if you kind of think through, and I've been spending a lot of time thinking through this dynamic, I think the challenge is if we were coming from a ZERP world when when cap rates was so low, right? I mean, it sounds kind of like, it sounds so crazy to say this out loud. If you buy an asset at 3.5% cap rate, which like warehouses are traded at, where some of the multifamily traded at, 3.5% cap rate. When the yield goes up, when the cap rate re-rates to 5.5% cap rate, if you do that math, right, you need a NOI increase of exactly 57%. You need your NOI to grow 57% to make up for the cap rate, expansion from 3.5% to 5.5%. I mean, like you could have like the best inflation protection via rent growth, but I'll bet you in 2 years you're not getting a 57% NOI growth, right? And I think that is and that's on an unlevered basis. You add some leverage to it, you really like need, you really start having problems. And I think that that's what's happened with, these hard assets is that I think they do offer great inflation protection in the long run. But in a period where you go from the ZERP world, where the 10-year was below 1%, cap rates were like, call it 3.5 to 4.5%, and then you have a 200 basis point expansion in cap rates, you would literally need 50% increases in NOI to be able to compensate for that cap rate expansion. And I think we went into a period where all these REITs, and this is why we shorted a lot of, we sold a lot of REITs going into 22. We even shorted a lot of long-term fixed income ETFs going into 22 as a hedge because we kind of saw the writing, we did the math, and we're like, we don't like what's happening. But I think that where the opportunity is so interesting is that we've overshot to the other side, right? If 3.5% cap rate is too low to take on all the risks of owning real estate. But by comparison, 6.5% is too high, is too cheap, just too darn cheap. And we're about to go into, like a multi-year period where new supply is probably going to be very, very muted, right? So now you start with like if you think about going into 22, you have this period where y- you know inflation is hot, rates were at all-time lows. The Fed likely have to cut rate to raise rates, and you likely have a scenario where cap rates will have to expand from call it 4% to 5%, right? And that may not sound like a lot, but it's actually a huge move in real estate. And now we got the opposite environment, right? Where let's add in the fact that they were building, the most amount of supply going into 22. Now we got the opposite dynamic where the public REITs, trade at very, very high cap rates, 6.5% for apartments, for great self-storage like CubeSmart. The Fed's cutting, right? The Fed's cutting. Supply gonna be below kind of historical norms. Yes, macro's a little bit weaker today, but and you actually could potentially benefit from cap rate compression because rates may come down. So it's a totally this is like the mirror opposite of like 21 going to 22. I think 25 going to 26 could be a very, very different environment.
Yeah, I think that's a really awesome and interesting answer because when you'd first said the 70s, my mind was thinking about the differences where like I'd looked at the REITs then because I'd always been very interested in Soros' reflexivity thesis, and he kind of formulated it with the what happened to the REITs in the 70s,
Hmm.
where you had kind of the launch of this asset class, right? That's when it was born.
Yep. Yep.
And the REITs soared in the beginning of the decade, and they were able to issue shares at way above NAV and just
Hmm.
buy more properties. And it was a rinse, wash, repeat cycle until it broke.
Yep.
And so I was thinking more about the differences insofar as the performance wasn't bad because of some trends in inflation in the 70s. It was just bad because it was a classic boom bust cycle. But actually, when you said that part about rates and how much you'd need NOI to rise to accommodate for the readjustment upward in rates, it's actually almost exactly the same. And the story is cost of money. The cost
Yeah,
of money for REITs was nearly free in the early 70s because they had really lush equity values. And the cost of money for REITs in the kind of in the 2010 to 2020 period was nearly free because we had ZERP. Different cause,
yeah,
same effect.
yeah.
And I think that's a really profound point and very interesting.
Yeah. But
Um,
Elliot, man, there's a reason why I didn't buy any, it seems like that, just like praising all the large cap blue chip REITs today. But for 10 years, I didn't buy any large cap blue chip REITs. I made a living buying these like under the radar, kind of hairy, some of the parts, like smaller real estate companies where you really need it to find that diamond in the rough. And today, the bargains are just like staring you in the face, right? It's just like people are just like people are literally saying, "This will never work." And I'm like, I could show you a gazillion comps that the private market is, there's like at least like 40% upside, and you're like clipping in some situations like a 6% dividend. I mean, we're like buying a REIT where it like the private market will imply 100% upside, and they're paying you 8% dividend, right? And then that's kind of like the target, the kind of environment that we're in today.
And Bill, I'll second what Elliot said about, how profound and helpful your answer there was. I'm wondering if you also think it's a timing issue and whether you can shed some light maybe on how the timing might work here. Obviously, as interest rates go up, we're not going to see NOI growth that would compensate for that to keep stock prices flat or growing. So it sounds like there's a lag effect in terms of NOI growth, because I presume NOI growth happens after wages start rising as well, nominal wages. Do we have any kind of insight or historical perspective on sort of how that timing sequences and how long it takes for NOI growth to really ramp up in an inflationary period?
So I don't necessarily like, I don't have the granularity on the NOI growth, but I've been in the real estate, so I don't have as much clarity or history on like the NOI growth going back decades. But as someone who's like steep in real estate, both on the public side and private side, one thing that I could say is that, and Sam Zell would say the same thing. And Sam Zell would say, hey, don't like delude yourself into thinking that your shiny office building is some like unique one of a kind. Okay, maybe Fifth Avenue retail is unique one of a kind, right? And we had a podcast on that. It's all it's all like supply demand driven, right? And your shiny Class A office in Midtown versus someone else's shiny. It's I think a lot of it is supply driven. And if you look at the rent growth in the last couple of years between Sunbelt, where they've built a ton of supply, they have essentially flattish or even falling rent. And then you look at the rent growth in markets like New York City and New York City adjacent, and they're just like a tale of two different cities, right? And I think ultimately supply is probably plays a bigger role. Assuming that demand kind of stays the same, supply, like real estate is all about supply. I mean, there's so I think the way that I think about the Sunbelt market, apartment market, is I think that we like if you look at the publicly traded REITs, they disclose the rent to income ratios. They're at like 19 to 21% for both Canada and Mid-America. I mean, the affordabilities are quite high for their tenants, right? And I think that once we get through I think the average like tenant in Camden makes like right around like $100,000 a year, and they're usually single in their 30s. Like that's a typical profile. I think that there's a lot of room for Camden to raise rent on that tenant base as long as they don't have you know a ton of competing, new building that are, got a gun to their head and have to, lease up their properties. And so, in terms of wages, like obviously wage growth is great, and they've highlighted that. Both these REITs have highlighted a lot of that on the earnings calls.
Yeah, and I'm wondering, when it comes to what you just said about us being in a very different situation now because we may actually see interest rates come down again. And it seems like the Fed and what's being done on the rate front is actually stimulative, because if the short-term rate is running below inflation, that to me is very bullish for companies with real assets and REITs specifically.
Yeah. No, I mean, I saw this happen after the GFC when, and there's a saying in equity investing is that equity is very forward looking. And, a lot during the GFC, I vividly remember a lot of REITs have went on a big rally before, operating stats actually started improving because people like David Tepper were on TV saying, hey, the government's basically telling you that they're going to lower rates. I don't know. I don't think we're getting that same kind of clarity in today's environment, but I think in general, what the Fed's trying to do when they lower rates is force people to go out the risk curve and take a little bit more risk. And I don't mean, doing super risky things. I think that just pushing people off hiding out in the 2-year treasury, earning whatever yield they are, to buying a high quality, low leverage apartment REIT like Camden Mid America. And I think there is, likelihood of some capital flow. And then, here's an interesting thought experiment. Like even through like interactive brokers, like, what you could borrow at like, on margin loans. You know, uh, I think that as the Fed cut rates, that margin cost, goes down. I think it's in like the low 5% right now. And if you really do believe that there's, a lot of price appreciation in some of these public REITs, like now you could kind of create your own like, arbitrage in the public markets. It's just something, I always say that interest rate is financial gravity, right? The lower it goes, the higher you flow. It's no secret that lower interest rate results in higher asset prices. So I think that the confluence of really good starting valuation today with supply kind of being very muted in the next few years and the possibility of like more rate cuts, it just sets up for a really good environment.
So on that note, in your letter, you talked about tail risks. That you're hedging for some tail risks. And in theory, one might say, real estate's a good tail risk if you're fearful of higher inflation, as we've just been talking about. But like, what tail risks are you most concerned about, and how are you hedging for them?
Oh, this is interesting. We always, I mean, there's like always like some macro unknown tail risk, right? So the way that we hedge it is that, well, let me start by explaining like there's a very specific real estate tail risk, which is the rise of like self-driving cars, right? So, right now, what's a good location? Like we understand that what's a good location may change over the course of 5, 10 years as like self-driving cars become um, more prevalent, right? So we actually bought some, leaks on Google because they own Waymo. Kind of partially because of Google was very cheap in our opinion, and this is when Google was trading like at half of what it's trading at right now. So we looked at the leaps and we thought, okay, like that's one specific tail risk to our strategy. And we bought leaps in Google going out to 2027, I believe. And ironically, like that's been like one of our better performing, like it's meant as a tail risk, but it's actually worked out really well. So that was like one of those like unintentional consequences of thinking about tail risk, but then like have Google go on this, incredible run recently. So I mean, but that's a real tail risk that we have to think about, right? Is the location value, will location value change over time because of self-driving cars? On the other side, I think there's just like a lot of silly lists in the market right now with companies like, the quantum computing, the Oklo, like all these like pre-revenue companies trading at $20 billion valuations. And we thought like that was an area where we could, buy some out of money puts in, even though they're like really, really far out of the money. So we bought some of that. And then generally we have been hedging via, just like a basket of companies that we thought were very, very cheap, very large cap with very liquid, options that where we can kind of create these like, oh, who's the author of Black Swan, the book, Taleb's, right?
Celeb.
Yeah, to Taleb, right? Like, just create these kind of like almost like synthetic CDS via out of money puts, where if we do have kind of big market corrections, and generally they don't work that well if the index sells off 5-10%, but they work very well if the index sells off, 15, 20, 25, 30%, which is exactly what happened in COVID, right? And we kind of roll them. I've been doing this for over 10 years, running the strategy. And, we own some calls in TLT, which is a 20-year US Treasury ETF. And that's not an interest rate bet. That's in case macro gets very, very weak, treasuries tend to rally. Now, I think like there's a lot of smart people who will say what's actually going to happen is that the yield curve is going to steepen. So the yield on the long end actually goes up. You know, Treasuries have a reputation for being good macro hedges, when economy gets soft. So we own some like calls in TLT as an instrument in case, macro gets weaker. So yeah, we have a basket of them. I mean, right now, macro, just like Joe, macro weakness is probably the most top of mind, and a lot of it is hedged through TLT. And then there's other kind of idiosyncratic, hedging that we do.
This has been terrific, Bill. Anything that we haven't covered that you want to share?
Maybe the only thing that we didn't get to talk about is there's like a lot of event-driven liquidations in the market, and maybe we probably need another podcast for that. There's an office, kind of like a well-known among value community called net lease office property that's liquidating. And I think it's just like very similar to what Buffett was doing in his partnerships, where he would do these like liquidations. There's more than one. Aimco is another one. Site Center is another liquidation. Where I think you're going to do pretty well over 20% IRs owning some of them. And I guess the other topic would be Elliot and I talk a little bit about cold storage and life science, which we haven't. We're still doing research on it, but I think like if you think about how much Vornado and SL Green, had returned from the bottom when the stock capitulated in early 2023, these are multi-baggers from the bottom. I think, Alexandria and Americold and Lineage has a potential to be multi-baggers, but we're not quite involved today. We're kind of paying attention from the sideline. I mean, some of those could potentially be like, interesting as a follow-up, conversation. But yeah, I mean, we cover a lot of ground. Maybe there's a little bit more on like office and office conversion, like, what we're seeing out there for the office market. I know that was like a big topic the last time we talked. And lastly, like, a couple, like some of the other asset classes like self-storage, maybe even warehouses. But like we don't have the time to cover all of them. But I think maybe like a follow-up podcast makes sense.
Yeah, definitely. We have a lot to cover. Just quickly on the liquidations, I take it those are kind of close the discount type liquidations.
Yes. So those liquidations, like, net lease office property, they're literally paying out these like very large special dividends. The stock is 25. We just received $4.10. They're selling more assets. Every time they sell a large chunky asset, they'll pay out, a big chunk of, you know, off them. And I mean, again, this is like I've been doing this for on the public side for over a decade. I don't remember the last time where I could invest in 4 or 5 of these liquidations, like, simultaneously. That's very, very rare. So, I think that's, like, another indicator of, like, how the environment that we're in today.
And you're estimating about 20% IRRs on those. How long do they typically take to play out?
I think that we did a math recently because we allocated heavily to it. I think that you'll get, like most liquidations, I think you'll get 70% of your money back in, like, call it the next 9 months, and then the remaining, there's probably, like, the full pay time frame is probably 24 months, but you'll be able to get a lot of your money out, like the bulk of your capital out in the next, like, 9 months by our estimate.
And
And
just
and
let yeah.
Yeah. No, I just wanna add a comment that, like, that's driven by, like, the assets that either has already closed, that are under contract, or they're actively marketing out in the market, and this is where, like, if we see, in a $500 million liquidation, we see, like, a $80 million asset being, marketed, we know that likelihood of that closing, is probably in the next like 6 to 9 months is pretty high, right? So this is where like the private network that we develop, or just like just actively staying on top of certain brokers, real estate brokers, like kind of like what I was saying earlier, like there's a certain unique skill set you need to develop and certain context that you need to have in this industry to be able to stay on top of that. And this is an area that we're very, and this is what we like is that you could close a discount, right? You're not relying on the public market saying should this trade at 6.5 cap or should this trade at a 5% cap rate.
Absolutely. And on something like Alexandria, and we can talk about this more in another episode, but you mentioned it could be a multi bagger. What do you need to get comfortable with to pull the trigger on something like that?
I kind of So Elliot and I had an offline debate about this, and Alexandria's got some unique challenges where they continue to have to finance new development pipelines. I think that generally a few things that we look for is kind of inflection in operating results. You kind of want to see things go from, continue to get worse, 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 and then at some point you see like a flatlining of results, and then now the stock may trade higher before you even reach that point, right? Again, equities are very forward looking, so like I think tracking the operating results and seeing if there is any, and then seeing if there's any like improvement in results, right, or expected improvement. You know, Tracking the sell side, seeing, if all the sell sides are bearish, that's pretty good starting point. And also if there's like one final cleansing event. I vividly remember when Vornado bottomed, it fell kind of 50% on like no real news. And I think that was a part of like a maybe like a coordinated bear attack. There should be no reason in early 2023 for Vornado to kind of fall from 25 to $12, right? We see a big cleansing event where at that point, I mean, Alexander's already down 80% from peak to trough, right? From, this is a $224 stock at one point. Now it's below $50. I think if we see like a big cleansing capitulation in the stock, I mean, that's probably where we would get it. And also, like, I would, if I start getting a lot of inbound from non-real estate, from generalist investors who want to pick my brain on Alexandria, that's usually a pretty good thing, no? So it's a mosaic of like different things that we look for.
Terrific. Well, let's wrap it up there. Thank you so much, Bill, for joining us and sharing these insights with our audience. Elliot, thanks as well for steering the conversation so ably. And thank you all for listening. Goodbye for now.
Thank you for listening to This Week in Intelligent Investing, brought to you exclusively by MOI Global, the research-driven membership organization. Learn more at moiglobal.com.